In fact, our projection is that basically over the next year or two, probably, the gold miners will triple in performance relative to gold. They're far better place to be. Silver will at least double in performance, if not more, than gold in this next phase. So yeah, gold is the mama. And when it comes out of this range-bound situation, it's been in since April, people will wake up and say, my golly, that's, I got to get in, 2,500, 3,500 gets taken out, for example. Then they'll wake up. Momentum says, don't wait. Already be there. But gold isn't the place to be. This time around, it's going to be.
Michael Oliver, Momentum Structure Analysis. Good afternoon to you, my friend. How are you?
I'm doing great, Andy.
Really good to see you. It's been way too long. I want to start with referencing a report that you did. I want to say it was over the weekend. If not, yes, it was over the weekend. You talked about, you're talking about the Fed cutting, and you referenced a chart from 2007 when the Fed started to aggressively cut. And then when we know what that was the beginning of the end here. What's your opinion on that? Is this the beginning of the end with a Fed potentially starting to aggressively cut?
Yeah, if you go back and look at the 2000 or 2007 tops, we called it a tombstone event. It's after a period of no rate changes, usually prior rises, but then no rate changes, a lengthy period. Suddenly the Fed starts to cut. And this is when our momentum works. As the stock market's topped, it's no good. And finally the Fed comes in and you'll see a rate cut. In both those cases, one was in January of 2001, which was only a handful of months off the high monthly close in the S&P, which had been August 2000. And you weren't all that far off of it in price. So you really hadn't, for most people, it wasn't the bear market yet, And the Fed cut twice that month. Unexpected. And then, of course, the market just went to hell for the next couple of years. Okay, so it didn't matter. They cut all the way down. It didn't matter. Okay. So anybody who bought, and there was a rally after that. There were two cuts that month. They were buying into that rally. They go, oh boy, the party's on again. And of course, that was a tombstone of it. If you just sold into the market, then you'd done great. Sold right into the good news. Okay. 2007. Market made a high, S&P 500, at 1550, 2 points above there, price-wise. Happened to be the same price high at peak in mid-2000. So it was up to the old 2000 price high after years of wasted time. And they sold into it, dropped down into the summer, came back up August, September, and mid-September, Fed cut rates by 0.5 point, which was a surprise rate cut. Been no policy change for quite a while. He suddenly cut rates. There was a 3-week rally that punched up through 1550 on the S&P, which means it took out the high of earlier 2007 and the high that occurred in 2000. So on a price chart basis, you sit there and say, oh boy, triple top breakout. Oh boy, party's on forever. Okay. If you shorted then, it was the top. Okay. They cut rates all the way down. The market went to hell. Okay, it didn't matter. Now we got a situation for a year there's been no change in policy, short-term rates. And now Powell has surrendered. His speech last week was a surrender speech. And in other words, he was saying, okay, I got enough Fed governors saying we need to cut. I got to agree now. We're going to do that. Okay, so they're going to cut. Question is a 0.5 point or what? It doesn't matter. But the market rallied sharply late last week due to that speech. And party time. In other words, it's party time again. Oh boy. And the rally, it was great for about a day, and that's about it. But it was already priced in to some extent because it was expected that they might cut in September anyway. 60, 70% expectation. Now it's 95 or whatever. So that's priced in. The question is this another tombstone event? Meaning, just circle it, be gone. This category is peaking. Okay. From our momentum perspective, where we look at price secondarily, but the long-term momentum of the market. You broke structure on a momentum chart that if you looked at the momentum chart rather than price chart, you said, oh God, we just blew the bridge. Okay. The rally back up since April low did not alter that. In fact, on momentum, it's to a lower high, despite price making a marginally higher high. So it's very important because I think this affects flow of money into certain other asset categories, namely, natural resource, gold, silver, monetary metals, even other more base metals. Whether suddenly there's a chorus out there, you can see it in some of the charts. And Momentum already said several months ago that, for example, it's time to buy copper miners again. It's time to buy rare earth minerals again, ETF. It's time to buy the lithium company ETFs, platinum stocks, and so forth. Platinum, which had not been moving with gold at all over the last years. And all of a sudden, all these metals, you throw a dart at them, they're all of a sudden moving up. Something's going on. A major asset class flow is occurring. And I think with the Fed panicking, as they normally do when their favorite asset, whether government debt or stock market, starts to break, they start to print more. The problem is for them, it never goes into where they want it to go. It's too late. It's already broken. It goes into gold and often into commodities. Mm-hmm. And I'm seeing that in just too many places, especially in the metals complex. And not monetary metals, but the other ones. All of a sudden, they're waking up too. What's going on? It's not particular to lithium. It's not particular to the rare earths. It's not particular to copper. It's a flow across the board. That's interesting. It's telling the decline in the buying power of the dollar or the increase in the quantity of dollars. Okay. Gold's gone up 11-fold. Okay. There's no comparison. So we're talking investment grade time period. Okay. You can even go 10 years, 5 years, 3 years. You get the same result, yet nobody's aware of it. Some people are, but too many investors really still aren't. All the metrics, they are. The American investors invested in gold and silver miners is like, trivial. It's still trivial. They haven't gotten the fever yet. When they start to get the fever, and it's already probably started, as you can see, since April, gold's gone sideways, steady. Miners have exploded. What's going on there? Silver's exploded since where it was in April. Okay. Mama gold is held steady. It's not a top. It's just a congestion zone. Meanwhile, the compatriots there have gone vertical. So they're starting to outperform again, which I think will continue. But a lot of stuff is going on that indicates asset class movement, including in the base metals. It's not necessarily specific to the metal, so you can look at the fundamentals of copper or lithium if you want, but it's really a more broad issue of money seeking a new place to be in an asset category that is vastly underpriced compared to other asset categories or even to itself. Silver, for example, $39 either side of it for a month now. Well, it was 50 in 1980. It was 50 in 2011. Very brief, phantom highs. If we match those highs in real dollar terms, it would be $200 an ounce. So our projection right now is silver's likely to go through 50 this year and end up in the 60, 70 zone by the end of the year. Not that that's a high, but that's where our working target is for the next surge. But we're starting to see that stuff in other markets, other metal markets. SIL, for example, even has a more pristine base on a price chart. Again, momentum spoke before this. But if you look at a SIL chart, go back 10 years, you'll see the same level hit. We blew through that a month or two ago, and we've gone vertical since. So it's really a fresh breakout for the miners when you look at the price charts. It's not something aged that needs to correct. And we're going to, I have no question in my mind, we're going to take out the 2011 highs in GDX and SIL, et cetera. And you can see the percent further gain that involves, which is not actually any more dramatic because we've already gained a lot. But that'll just put them, back above what gold was at 1,920 in 2011, it was above there in 2020. It got up to 2,070 or something. So they're finally catching up to gold in terms of their own historic prior price highs. But I think they're going to lead from here on out in terms of percent gain. In fact, our projection is that basically over the next year or two, probably, the gold miners will triple in performance relative to gold. They're far better place to be. Silver will at least double in performance, if not more, than gold in this next phase. So yeah, gold is the mama. And when it comes out of this range-bound situation, it's been in since April, people will wake up and say, my golly, that's, I got to get in, 2,500, 3,500 gets taken out, for example. Then they'll wake up. Momentum says, don't wait. Already be there. But gold isn't the place to be. This time around, it's going to be silver, gold and silver miners. They'll vastly beat gold.
Well, a couple of things on that. If just you mentioned at the beginning of this conversation, if the allocation, it's not even at 0.5% nowadays when it used to be historically, what, 2 to 10%. Just imagine, I guess this is more of a comment, just imagine if and when that happens again, that allocation again, talk about money flow, right?
Yeah. No, and when you pierce a hole in the price action of the stock market, which momentum says you're already broken, price is teasing you with a marginal new high. It did the same sort of process of a marginal new high in late 2007, of a marginal new high in mid-2000, after we put out a sell signal in January 2000, made a marginal new high. But it was false. Momentum said, no, you're broken. Sorry, guy. Price went up and said, oh, it made a new high. It was a trap. And I think, and also we had those rate cuts, as we talked about earlier. I think we're in the same position now. The issue is when you start to break that beast, right now, the only thing the average middle-class guy on up has to smile about is, hey, my 401k, my retirement account. It's, oh boy, I made a new high, because if it's linked to the S&P, let's say.
So one of the asked is, if we have a downturn in the stock market or even a crash or a credit crisis, if you would, what's your opinion on that affecting both the commodity price in gold and silver and also the miners? What would you say to that?
No, I don't buy into it. There was a time when you, again, think from an investment perspective, not this month or that month. Okay. 2000, the stock market top, gold was bottoming. 2000 to 2002, it went down. S&P went down 50%. Nasdaq 100 went down 82%. Gold rose all during those years. In fact, continued up through 2011. But in 2008, remember the S&P hit a high, 1550 in 2000. It wasn't until 2013 that the S&P was ever able to take out that high in a credible way. Okay. All during that time, gold rose. Yes, there was a month, October of 2008, part of September, the month before, where gold did implode and silver imploded. It was very brief, and they were back to their highs quickly. Okay. Where people say, oh, see, it went with the stock market. The stock market at that point, October 2008, was already a full year into a bear trend, had gone down significantly in price, while gold continued to rise. And it was only during that event, crash month in October 2008 for the stock market, went down 30-something% in weeks. It's a crash event. Gold joined in. Gold at that point, technically, frankly, needed a correction. And it had one, a sharp one. Mm-hmm. At the end of that October crash, Bernanke, who had been cutting rates all the way down, it didn't help the stock market, finally decided to go to QE. He took the Japanese textbook and said, we're going to do that too. Stock market continued down until March of 2009. QE didn't help it. Gold was back to its high rapidly. Okay, so when you get the implosion in the stock market, you get the central banks to go berserk, which helps gold. Okay, that is one of the few examples in history where you could find a sharp downside in the stock market with a sharp downside in gold. I happened to catch the 87 crash in the stock market. It was 35% in a matter of 2 weeks, S&P. Gold rose 7% in those same 2 weeks. Okay.
Well,
Okay. Now look at this year. Wasn't a crash, but the S&P dropped 21% from its January high to its April low. A lot of that compressed in the final few weeks, so fairly dramatic. Gold rose all during that time, dramatically.
You just heard Michael Oliver lay it all out. Silver could double, miners could triple, and the Fed is about to do what it always does when the market gets shaky: panic, surrender, and start cutting rates. Now I want to step back with you for a moment and look at why what he's saying matters. Not just in a technical sense, but in the bigger picture here in the US economy and financial markets. The Federal Reserve loves to act like it's in control. But if you look at history, the big rate cut cycles almost never arrive at a time of strength. They show up after the damage has already been done. In 2001, the Fed slashed rates aggressively after the dot-com bubble burst, and yet the Nasdaq still lost nearly 80% of its value. In 2007 and 2008, they cut and cut again, but it didn't stop the S&P from dropping almost in half. Every time those cuts were celebrated at first as a sign of relief, but in reality they were tombstones, not lifelines. When Powell starts easing today, he isn't saving the market. He's admitting that things are already breaking. That's where money flow comes in. When people lose faith in stocks and even bonds, they don't just sit on cash forever. Capital looks for a new home. And that's why Oliver's call that silver is going to vastly outperform gold this cycle makes sense. Gold has already done its job. It's held steady near highs, acting like the anchor. But silver? Silver is the metal people forget until it's already running, and then it moves fast. Think about where silver is right now compared to history. In 1980, it touched $50. In 2011, again, it hit that same level. Adjust for inflation, and those highs would be close to $200 today. Yet, here we sit, with silver struggling under $30. That disconnect is hard to ignore. What makes it even more interesting is that unlike gold, silver isn't just a shiny lump stored in a vault. More than half of silver demand comes from industry. Solar panels, electric vehicles, smartphones, medical equipment. Silver is woven into the infrastructure of the modern economy. Every year we consume more of it, and yet mine supply has been flat for years. The Silver Institute has pointed out that we're running a consistent deficit using more silver than we produce. That can only last so long before the price adjusts. That's why when Oliver talks about silver pushing through $50 and running to 60 or 70 in the near term, it's not just a chartist's fantasy, it's the collision of supply, demand, and investor psychology. And psychology matters. Nobody pays attention to silver until it clears a big round number. If it breaks $50 and keeps going, that's when the public suddenly notices. Your coworker who never cared about metals will start asking about coins. Your neighbor will talk about miners. That's how parabolic moves start. The miners are the overlooked leverage in this story. Most retail investors don't touch them, but when the metals move, the miners amplify the gains. That's because their costs are relatively fixed. If silver rises 20%, the profit margin on every ounce they pull out of the ground can double. That leverage can be brutal in downturns, but in an uptrend, it turns a steady climb into a rocket. We've already seen ETFs like SEL and GDX breaking out after years of being dead money. If Oliver is right that silver will at least double in performance, the miners could easily triple. One of the most common fears people have is that if the stock market crashes, metals will crash too. And yes, in a blind panic, everything sells off for a moment. In October 2008, silver and gold both dropped along with stocks. But look at the full story. They snapped back quickly and went on to new highs while the S&P kept bleeding. In the early 2000s bear market, stocks fell for 2 years while gold and silver quietly rose. Even in 2022, when markets sagged, gold held its ground better than most sectors. The point is, metals are not chained to the S&P. In fact, they often thrive when equities stumble, especially once the Fed starts panicking. The backdrop in the US right now makes all of this even more compelling. We're sitting on over $35 trillion in national debt. Servicing that debt at 5% rates is becoming unbearable, which is one of the real reasons the Fed will cut. The dollar has already rolled over this year, breaking down after a long period of strength. And while the official inflation numbers have cooled, anyone buying groceries or filling a gas tank knows the pain is still there. If commodities start another leg higher, inflation isn't gone. It's just sleeping. The Fed is trapped. Keep rates high and something breaks. Cut rates and risk fueling another inflation wave. Either way, silver benefits. What makes this moment feel different from past silver booms is the combination of drivers. In 1980, it was speculative mania. In 2011, it was fear after the financial crisis. This time, you've got both investment demand and industrial demand converging. Even if no investor ever bought another ounce, solar and EV manufacturers would still need silver. That creates a baseline of demand the market has never had before. Add to that a public that hasn't even woken up yet. U.S. portfolios on average have less than 0.5% exposure to precious metals. And you've got a spring coiling tighter and tighter. So when you hear Oliver say silver could double, miners could triple, and gold might actually be the laggard this time, it isn't just theory. It's a story backed by history, by supply and demand math, by Fed behavior, and by the psychology of investors who always seem to arrive late to the party. The truth is, nobody can time it perfectly. But the setup we're looking at now, Fed on the verge of surrender, dollar sliding, debt unsustainable, industrial demand roaring, and silver still dirt cheap, looks like the kind of window that only comes along once in a generation. And if history has taught us anything about silver, it's that when it goes, it doesn't go slowly. If you enjoyed this breakdown and want more insights like these, don't forget to hit subscribe and join me here every week for deeper dives into the markets.